Good morning and welcome to the Open here on BNN Bloomberg. I'm Roger Peterson. Thank you, as always, for joining us. Now, let's get to some of the stories we are following in the BNN Bloomberg newsroom. The Bank of Canada will announce its latest decision on interest rates later this morning. The BOC widely expected to leave the key rate unchanged at 2.5%, which would be the fifth straight hold. Reasons for that include conflicting economic signals, ongoing uncertainty around Iran, and, of course, U.S. trade. U.S. inflation rose in May as the Iran war continues to push up prices. The Consumer Price Index climbed 4.2% from a year earlier, the highest level since early 23. The core CPI increased 2.9% from last year, while the cost for transportation services, health insurance, and new vehicles dropped. Economists anticipate rising prices in the near future, leading to a potential interest rate hike. Apotex has raised $1.3 billion in its initial public offering. It's Canada's largest since 2021. The generic drug manufacturer priced its IPO at $24 per share. The listing comes nearly a decade after the murder of Apotex founder Barry Sherman. His wife was also murdered. Honey, the company, was sold in 2023 to New York-based SK Capital Partners. And looking at the markets right now, you can see there is a bit of a concern right now. The sell-off happening in the U.S. You can see the Nasdaq's off by 0.88%. Tech taking a hit right there. S&P 500 also off by about 0.54%. All of this also concern over what is unfolding in the Middle East with Iran and the CPI data that just came out. It's a busy day for them. Looking at the TSX and where it closed yesterday. Off slightly yesterday and dragged down by materials and energy, and seeing it down below 34,500, but still up for the year. Oil now, and you can see it's up today. No surprise there with the pressures that are unfolding in the Middle East. WTI up by 1.32%, and still below 90 a barrel, though. Looking at the metals, gold, and it has been in a bit of a free fall for the last little while, and you can see now it's trading well below 4,200, off by more than 2.5%. Canadian dollar up 0.1% to be exact, at 71.76. And for Bitcoin, which has been struggling lately, it is down again today, another percent, back below 61,500. U.S. stock futures trending lower after U.S. President Trump signaled that Iran negotiations are taking too long. Chip stocks also under pressure. Let's get perspective from Kyle Taylor, wealth advisor and portfolio manager at Tri-Delta Private Wealth. And Taylor, Kyle, thank you. It's been a long morning already, and it's just starting. Kyle, how are you? Thanks for joining us.
I'm good. Thank you so much, Roger.
Appreciate you joining us today. Okay, can we throw in the inflation numbers as well? Your thoughts on everything that is unfolding right now?
Yeah, well, there's certainly no shortage of it. Ultimately, 2026 earnings did a lot to put the markets on good footing. But as that constant earning news has rolled off, I think the market is looking to other headlines, other narratives that could signal what the rest of the year holds. There's no shortage of potential sources of volatility that investors will be grappling with, whether that's rising inflation and how the central bankers react to that, or the wave of AI IPOs this summer, the stumbling that's currently being seen with some of the AI and chip names, maybe a reassessment on some of the value that people have seen grow over the past couple of months. And then you have tariff drama and everything to do with the Middle East war and the associated impact on energy markets. It's one where I think investors need to be very deliberate in what they're owning. I certainly wouldn't say that I'm in the or was in the sell in May and go away camp. But I think that the opportunity is in individual names rather than in general sectors or even regions for that matter.
There is so much for a nice, quiet summer. It is shaping up to have a lot on the plate for. There's a little bit of everything for everybody that you can worry about. Pick what you want to worry about. Let's talk
Well,
first. Sorry, go ahead, Kyle.
Well, I was going to say one of the ones that I think is, and most investors are pretty keenly aware of today is just around the SpaceX IPO, which is coming out on Friday, and the expectations for OpenAI and for Anthropic later this summer. I think that'll be interesting and very telling into what the AI theme has in store for investors for the remainder of the year. And it'll be a big test for call it the Elon Musk premium around retail investors and buying into this IPO. One of the parts that I've been mentioning to clients is the fact that buying into an IPO used to feel like you were buying into the ground floor of a new and upcoming business, and now today it's more like parachuting onto the roof of a skyscraper while the pre-IPO investors, the insiders, take the elevator down and walk out the front door. So I think that's something that people need to be keenly aware of, and I think it'll be certainly a big news day on Friday.
Now, and did I hear it's how many times over? Did I hear 4 times oversold?
Yeah, yes. I mean, one of the interesting things I was reading just yesterday was the fact that typically with IPOs, about 5 to 10% of the allocation is carved out for retail investors. And Elon Musk, I mean, he knows what he's doing. He's playing into, I think, the retail side of things that he's been so successful with Tesla and some of his other notoriety. And I think they carved out around 30% for retail investors. So it's one of those things where if I understand why people want to participate, I think it's an interesting business. But it's about a $1.8 trillion valuation on a business that's earned, I think, 18 billion last year and has never earned a quarterly profit.
So I'm going to guess you're staying away from it, is what you're telling me.
You know what? I can't say I'm investing in it personally, but I do have several people in mind who I know are very keenly looking to participate, and I think there will be others like them.
And is there anything you're going to be looking for with this IPO that may say, oh, things are looking good, or go, uh-oh?
Well, I think what will be most interesting is just the price action that we see in those first few days and weeks. I mean, there's been plenty of stories over the years around stocks that had notable IPOs and rallied at first and sold off over the next few months before kind of getting their footing around profitability. I think one of the interesting things that people may be looking at is just the case study with Tesla. I mean, Tesla was unprofitable for years. I mean, I still don't think their valuation makes much sense, but Elon Musk has this inherent talent of raising capital and being able to use that notoriety in order to fund their operations and one day achieve profitability. And I think people will be looking to apply that to SpaceX.
And we haven't talked about this in a long time. Bubble.
Bubble talk.
The bubble talk. It's time for bubble talk, everybody.
Yeah, well, I think
are we bringing that word back?
It's
been put away for a while.
Yeah, well, I think those voices will get louder as the summer rolls on, depending on the success of these IPOs with Anthropic and OpenAI in particular. I mean, the more success the AI theme has, I think those voices will get louder. I think Q1 earnings did a lot to settle some of those concerns, just in demonstrating that profitability is real, and there is a lot of cash flow to back up these names. One of the things that I think has been really great to settle some of those concerns is a lot of what came out in Q1 around some of the companies that are looking to secure longer-term, multi-year contracts for their products. Micron was a really great example of that, looking to sign 5-year-plus deals with their customers around their products, and I think that did a lot to add to visibility and ease some of the concerns around the durability and the cyclicality of some of these names.
All right, let's get to a couple of stocks that have got your attention right now. Chewy, not Chewbacca, but pet food or pet treats.
Chewy actually reported earnings just this morning and relatively in line with expectations, maybe on the lower end of guidance, which we were largely expecting. They're maybe a bit more of a household name in the US than in Canada. They're pretty recent into Canada, but they're the largest pure play online retailer in the US for pet products and food, with 21 million active customers across 3,200 brands and 130,000 products. It's a growing markets, but it's also one that hasn't really seen the online adoption that maybe some of the other products in the e-commerce space have seen. They've got a lot of really great long-term growth drivers, including just sector growth, pet pharmaceuticals and services, and international expansion. One of the things that I think investors have been really glad to see from Chewy is the fact that they've invested into some more brick and mortar vet clinics and the cross-selling that opportunities that provides them. The challenges of late for Chewy have been more around the deteriorating consumer outlook, and the share price over the past few months largely reflects some of the macro concerns that have been seen there. I think the pet sector at large can be one that is very narrative driven, just in terms of pet adoptions. And I think even if you just look at the stock chart from COVID, that's pretty demonstrative of that reality. But management has made some really great decisions in diversifying revenues. The fundamentals are good, and even though I think Amazon can be seen as a natural competitor for them, Chewy actually has a lot of great discounts for auto ship, which is about 85% of their customer base, which tends to be rather sticky. And about 2/3 of their customers actually are estimated to have Amazon Prime memberships already, but still order from Chewy, largely because their products are kind of in between 3 to 16% cheaper with still 2-day shipping. So I think it's one that has a lot of durability. It's one that became pretty attractive to us from a growth standpoint, given where prices had fallen. And I don't think you could look at many businesses today that have a better balance sheet than Chewy. I mean, they have no long-term debt today, and the cash flow that they're generating is enough to sustain themselves and grow their product base and continue to market into new international markets.
All right, we've got to wrap up there. We're out of time. The other one you liked was Paychecks. We'll have to talk about it next time. Kyle, thank you as always, sir, for joining us. Appreciate it.
Thank you.
Kyle Taylor, wealth advisor and portfolio manager at Tri-Delta Private Wealth. Coming up, is now the right time to be bringing in reforms for the U.S. banking industry, or does it create unnecessary risks for the U.S. financial system? We'll hear from the head of the U.S. FDIC next. The head of the U.S. Federal Deposit Insurance Corporation, Travis Hill, says he fully disagrees with U.S. Federal Reserve Governor Michael Barr's warning that recent regulatory changes could weaken bank safety and soundness of the U.S. financial sector. We got perspective from him in a Bloomberg interview where he explained why these reforms won't lead to greater risk.
We do have an aggressive agenda to reform our regulation and supervision of the banking industry, but we are trying to bring it to a balanced place. We want to make sure that our examiners are focused on the types of risks that are material to a bank's safety and soundness and to financial stability. If you look at Silicon Valley Bank, the Federal Reserve had a long list of supervisory criticisms when the banks failed. Almost none of those were actually relevant to the financial condition of the bank at the time that it failed. So we want our examiners focused on the actual material financial risks, and so that's what we're focused on. Well,
hence the reforms to the CAMELS rating system. I know the comment period just opened a few weeks ago when this was officially proposed. It runs through August. But can you give us a sense of what feedback you are getting to those changes, specifically the reforms to the management component?
Sure. So as you said, I mean, we just put out the CAMELS proposal, so comments are just starting to come in. Most of the comments usually come at the end of the period, but the reforms to CAMELS is just one piece of several things that we're doing to reform supervision, and so the general spirit of all of this is to try to focus the attention on the fundamental financial risks and have less focus on process-related things around how those risks are managed.
Well, and how do you guarantee that changing your view of fundamental financial risks doesn't ultimately still lead to greater risks in the system? What happens, Mr. Chairman, if you're wrong?
Well, we're always trying to get the balance right between enabling banks to drive economic growth and serve their customers and communities, while at the same time making sure that they're doing so in a safe and sound way. Of course, we at the FDIC are the resolution authority, and so when banks failed, we're responsible for resolving them in an orderly manner. So we are always vigilant to downside risks, and we are always prepared in the event that we do have bank failures.
Well, and of course, when we consider bank failures when they happen, there's a cap on the deposits covered by the FDIC of $250,000. But there is a big legislative push to actually see that cap raised, specifically when it comes to business and non-interest-bearing transaction accounts. There's legislation put forward by Senator Bill Hagerty, for example, that would raise that to $5 million for accounts such as that. Do you see the need for that to help level the playing field between the smaller guys and the big ones?
Yeah, look, I think it makes a lot of sense that Congress is looking at this now. It's been almost 20 years since the last time that Congress raised the deposit insurance threshold. Historically, Congress has periodically raised the threshold over time. The percentage of deposits in the system that are insured has come down a lot over the past few decades. It was about 80% of deposits in 1990 were insured. Now it's more like 55%. I think that if we're talking about reforming deposit insurance, I think that having a new category with a higher cap from a public policy standpoint achieves more than just a straight raising of the cap. So I think the notion of trying to target a certain category of deposits, like Senator Hagerty's bill did or proposed, I think that makes a lot of sense, and we've been closely engaged with his office and others on Capitol Hill on that.
Well, and it gets to this idea of competition and the smaller banks being able to compete greater. Do you see a need for consolidation to achieve some of that as well? And I wonder if you actually think the easing or the changes you're making on the regulatory side actually could pave the way to more M&A in the community and bank space.
Yeah, so I think from our perspective, having a diverse banking sector with banks of a variety of different sizes and business models is very healthy. It's unique to the United States. That being said, from our perspective, we don't have a desired end state in terms of what the right number of banks are, what the right number of banks in different pockets of the industry are. I do think that having healthy M&A is important for a vibrant sector, and so we are working on some modifications to our merger review process to be faster, more transparent, more open-minded about merger transactions. I think the biggest piece to consolidation, at least since the 2008 financial crisis, has been the huge decrease in new entrants into the banking system. And so another thing that we are looking very closely at is how to encourage more de novo activity to encourage more new entrants into the system.
As we consider new entrants in the system, there's obviously the question around digital assets as well, and specifically stablecoin rewards that the banking industry has a big problem with as we consider the future of the Clarity Act on Capitol Hill. How great is that risk in your mind that you actually could see deposit flight from banks due to these reward programs?
So that's a very complicated question. As a general matter, when a customer takes funds out of a bank account and puts it into a stable coin or into some other type of non-bank account, as a general matter, those funds don't leave the banking system. They just get redistributed because effectively it goes from the customer's deposit account to the stablecoin issuer's deposit account. If the stablecoin puts that into Treasury security, then it goes to whoever sold the Treasury securities bank account. And so it's basically moving from bank account to bank account to bank account. That being said, it is fair to say that there may be different risks associated with different types of deposits. And so that could still have economic and other impacts on the banking sector. So these are things that we are thinking very carefully about as we implement the Genius Act. And obviously, as you noted, Congress continues to debate this as well.
Was Travis Hill, U.S. Federal Deposit Insurance Corporation chairman. Up next, we'll turn our attention back to Canada's largest IPO since 2021. Apotex raises $1.3 billion. Apotex has raised $1.3 billion in its initial public offering. It's Canada's largest since 2021. The generic drug manufacturer priced its IPO at $24 per share. The listing comes nearly a decade after the murders of Apotex founder Barry Sherman and his wife, Honey. and they have never been solved, those murders. The company was sold in 2023 to New York-based SK Capital Partners. For more on this, we're joined by Bloomberg's Melissa Shin. Melissa, thanks very much for joining us. First big IPO, really big IPO, I guess, for Canada in 5 years now. What does this mean?
Yeah, people are pretty excited about this. It was a peak of 77 IPOs in 2021, and since then, the number of public companies has actually been shrinking on Toronto stock exchanges because of take privates and delistings. And so this really potentially signals a big change, and people are looking forward to that. The last big IPO that you mentioned in 2021 was Definity Financial Corp, and that raised $1.6 billion. So it's an exciting time for capital markets here.
And tell us also at the time now. So what are investors excited about with this company? What are the opportunities do they see?
Yes, so Apotex is a generic drug maker, and we may have all heard a lot about Ozempic, which went off patent protection here in Canada. And so that's a Novo Nordisk drug. And so now Apotex and another company are two companies that have been approved by Health Canada to make generic versions of Ozempic. Actually, Apotex was the first of the two companies to release the actual product. So that's one thing that I think people are watching. And in addition, just more generally in terms of revenue and adjusted EBITDA, according to the prospectus, those have been growing over the past couple of years. So, that's another thing to watch.
And this is a company with a track record too, right? It's been around for 50 plus years.
Yes, that's right. Yeah.
Okay, and going back, you mentioned that we had the big ones, a couple of big ones back in 2021. Where are we at with the TSX then at this point in those 5 years?
Yes. So at this point, this would be one of the largest life sciences IPOs in TSX history by total proceeds, and it also is one of the largest in general, according to the TSX. And then there are about 110 life sciences companies at the moment, excluding Apotex. And so this is, just an area that we don't have as much of an allocation to. Canada's stock exchanges tend to be very financial, energies, materials. So this is an area that it's nice to see a bit more growth here. And so, again, exciting times.
Yeah, just to see the TSX expanding is always a good thing. Melissa, thank you very much for joining us today.
My pleasure.
Bloomberg's Melissa Shin. Well, the opening bells are coming up next. There you go. That is the opening bell at the NASDAQ. Enride AB ringing the opening bell there. Got the family out to celebrate this momentous occasion for them. And at the New York Stock Exchange, it was EROC ringing the bell. TSX, the 25th Canadian Annual Derivatives Conference, opened the market to celebrate the 25th anniversary of the Canadian Annual Derivatives Conference. Time now for the first 15. This is BNN Bloomberg. Trading is just getting underway. Let's take a look on the equity markets and see where things stand. No surprise, another pullback shaping up for today. The TSX opening down 0.68%. We'll see where it goes by the end of the day. And the S&P 500 also off by 0.6. And the NASDAQ as well is down by 0.73. Okay, we want to check out some banks and some other stocks right now to see what they're doing. The Canadian banks are catching some people's interest right now. The first one up is Royal Bank, and it is down slightly right now. But some of the news that we're hearing from it today is that They're concerned about the Bank of Canada decision, of course, which could impact them. But some other stories we want to tell you about. Royal Bank is first up, and it's pushing to expand its U.S. financial markets with plans to hire more senior bankers and new graduates, which is good news. RBC Capital Markets earns half its revenue in the U.S., has been adding people in the country for the past 7 months, including managing directors, and it's going to expand its U.S. trading businesses, including equities, credit, and macro operations, and use AI to drive productivity, such as research and in trading. And the other one we want to mention is CIBC. Let's see where it's at right now. It's up slightly by 0.28%. And it is set to offer Canadian investors access to SpaceX through a vehicle that gives local investors access to global stocks. The bank will launch a SpaceX Canadian depository receipt on the Toronto Stock Exchange, with trading expected to begin on Friday when the IPO goes, according to a release. And that's when the public offering SpaceX will start trading. The public offering is set to price Thursday. So CIBC introduced CDRs in 2021 and has 132 of them right now. And south of the border, let's take a look. NVIDIA is off right now, and tech stocks are taking a hit right now. It is off by 2.4%, leading decliners among Magnificent Seven stocks, with technology and semiconductor firms set to extend their losses. Chewy is another one we want to take a look at. It's a pet food company, and it's down 4.3%. Ahead of the bell, erasing an earlier advance. It was up at about 9.5%. Management said on the conference call that it now expects active customer additions to trend toward the lower end of its previously stated range of approximately 150 to 250,000 net adds per quarter. But we no longer believe it is prudent to embed a meaningful acceleration in consumer spending into our outlook, given the current operating environment. And one last one to take a look at, Cracker Barrel. It is up more than 17% right now. The restaurant chain boosted its revenue guidance for the full year, beating the average analyst estimates. And a lot of that is on the Americana stuff that they sell at their restaurants. Whimsical salt and pepper shakers that look like drills, and 250th anniversary, U.S. 250th anniversary T-shirts and hats and all that stuff. They're making some money off that, and that's how it's happening. Okay, up next, a look at how a new U.S.-Canada border connection will benefit a variety of sectors on both sides. Once the Gordie Howe Bridge is open for business, several sectors will benefit. It's in the Windsor-Detroit crossing. It'll benefit from the ease of going back and forth across one of the busiest border crossings anywhere, and including truckers carrying Canadian goods. CTV's Adrian Goldbrill looks into that aspect of trade between the two nations.
Spanning 2.5 kilometers across the banks of the Detroit River, the new Gordie Howe Bridge has sat idle. That is about to change.
It's been 25 years in the making. I'm happy to hear this.
The old Ambassador Bridge has been the busiest along the Canada-U.S. border for years. More than $390 million in trade traverses the route each day, representing 26% of Canada's exports and 33% of all imports by road. Here inside CSA Transportation, freight is moved into hundreds of big rigs that cross into the United States every day with increasing difficulty.
It's expensive, really long lineups, so it's caused delays in moving freight cross-border.
How important is another border crossing, another bridge for your industry?
Trucks that are crossing the border, it won't be as long waits. It'll be cost-effective for them, and if it's more cost-effective for them, then that passes on to the consumer.
Detroit and Windsor, Ontario have been bound by two automotive economies.
There's $100 million worth of auto parts that goes across that bridge in either direction every single day.
The president of Canada's Auto Parts Manufacturing Association shares his belief that the new bridge will remove a bottleneck at the border with more direct routes to market.
The route to this bridge is in from a highway, out to a highway. Anytime you can improve those processes in public infrastructure, you're winning.
For the mayor of Canada's automotive capital, the pending opening is a victory years in the making.
Being able to have certainty in crossing the border is imperative for this auto industry and parts sector to work seamlessly. It's going to be great for commerce, great for community.
The consensus among multiple industry leaders we spoke with is that shorter wait times at the border and cheaper tolls should deliver savings for Canadians. Adrian Gobriel, CTV News, Toronto.
Ontario's premier is on a charm offensive in Washington in advance of CUSMA trade talks during his trip to the U.S. Doug Ford said the Americans rolled out the red carpet. CTV's Abigail Beeman has more.
What's the pitch?
Well, the pitch is building Fortress North America.
Ontario Premier Doug Ford takes to American airwaves again.
What is Fortress North America?
Well, Fortress North America is about encouraging people to invest more in both countries.
Selling not just his province, but his new plan that highlights the benefits of the Free Trade Pact ahead of the July 1st deadline. Echoing Canada-U.S. Trade Minister Dominic LeBlanc, Ford says he's optimistic about a deal, and he downplayed a cancelled reception with American billionaire Ross Perot Jr.
We have been jammed, meeting everyone down here. They've rolled out the red carpet for us. They treat us so well.
A ban on American booze is a major irritant for the Trump administration. Ford said he'll back off if there's a trade deal.
I just want to get this deal done, and then we'll put that booze back on the shelves, and we welcome everyone. Maybe we'll have a little drink of Kentucky bourbon or something in Ontario.
But the premier has also been a lightning rod.
America's jobs and growth are at stake.
With the U.S. president calling off trade talks after this Ontario ad, Ford said he had a positive chat with LeBlanc ahead of his trip. Other ministers displayed a united front.
You know, it's always good to have Team Canada talking about the benefit of the relationship.
Tariffs are really, really hurting a lot of Ontarians and a lot of Canadians. And I think it's important that we talk to American leaders across the U.S. I'll be going to the U.S. this summer. There will be many of us that will be going.
Premier Ford has taken a very positive approach, almost conciliatory, compared to other statements that we've seen in the past. So pour a little sugar on it.
Ford said he was meeting 4 American lawmakers today, but no one from the Trump administration. He's leaving that up to the feds. LeBlanc has said he'll be speaking with his U.S. counterpart this week.
And that's CTV's Abigail Beeman. Just ahead, what to expect when the Bank of Canada announces its rate decision. That's just minutes from now. Stay with us. We're just minutes away from the Bank of Canada announcing its latest decision on interest rates. Now it's widely expected the rate will stay unchanged. The U.S. war in Iran, tariffs on steel and aluminum, a technical recession in the first quarter of the year have weighed on Canada's economic outlook. Let's get more now from Earl Davis, head of fixed income and money markets at BMO Global Asset Management. And Earl, thanks very much for joining us today. What are the zero? Can we say 0%? Anything but standing pat?
Yeah, we're like the market. We do expect the Bank of Canada to leave the rate unchanged today. What's interesting about the market, it is expecting one hike by the end of the year. That we have a differing view. We don't believe the Bank of Canada will be hiking nor easing at this point. But we have a different view on our expectation for the Bank of Canada for the balance of 2026 than the market does.
Okay, so how are you looking at things and what makes it different and why?
Yeah, well, obviously the growth numbers were, even though it's a technical recession, we're still bad. We're still negative. So we'll have to see how much growth can rebound and if it does rebound. The other thing that we're looking at is employment. You know, we did have a very good employment number in Canada, but, there are some people who surmise that is because of World Cup and the services industry and tourism. So we'll have to see the next couple of months of employment, whether there is a maintenance of the 6.6 level or whether that declines again. We think there's a higher likelihood of an ease than a hike, but our base case right now is for no change by the end of the year.
But with those employment numbers, I thought, weren't a lot of them full-time hires, though?
Yes, and that's very interesting. A lot of them were full-time hires in the services, but that's why you have to look at it over a 3-month period. What is the average? Is there noise in that? So yes, it was a positive number. I can't deny that. And we also saw a positive number in the U.S., and that was driven by World Cup, they said, in the services industry. But we'll have to see what the next few months bring on. Another thing that will influence the Bank of Canada too, which is why we think the base case is on hold, is what does the FOMC do next week at their meeting? Do they move they will not change rates, that's for sure. But do they move from an easing bias to more neutral? And that could have an impact on the market as well and on the Bank of Canada.
And is the Bank of Canada influenced by what the Fed does?
Not indirectly, yes, most definitely yes. And the reason why is if they're going in an opposite direction. So there's two reasons. One is it has an impact on the currency in regards to looking at interest rate differentials. And our currency does impact our exports, does impact inflation. So they do look at it as an informational point. They don't make their decision of it, but it is an important aspect for them as well, too.
All right, and the number's out, and surprise, surprise, it's 2.25%. So if that's what you were betting on, Earl, you're a rich man.
Yes. The thing too that's important, and obviously I don't have the statement in front of me. The last statement was a bit more hawkish. The market took it as hawkish because the Bank of Canada wanted to leave all their options open, not just for a possible ease, but also for a possible hike, because of the inflationary risks and uncertainty. So I'd be curious to see if the statement toned that down a little bit, which is my expectation.
I'm just looking to see if we've got that statement yet. And did we get it?
And the reason why the statement is important, this one, is because there's no monetary policy economic update. That'll come at the next meeting. So you have to read in between the lines of the statement as to what the Bank of Canada is thinking going forward, since we don't have that economic update at this meeting.
Okay, here's what Tiff had to say here, Tiff Macklem. Economic weakness combined with rising inflation is a dilemma for monetary policy. Raising rates to dampen inflation could further slow the economy. Easing rates to support growth increases the risk that higher inflation becomes persistent. And then added, monetary policy needs to be nimble as uncertainty remains elevated, and pretty much repeated language from the April decision that on the potential need to cut the policy rate to support growth if the U.S. imposes significant new trade restrictions. Just some of the things that Macklem had to say so far.
Yeah. So that word dilemma is an important word for me. To me, that says unchanged rates for the balance of 2026. It's a kind of what the market is doing right now. It's kind of wait and see approach in regards to, I believe, the increasing risks of lower growth in Canada based off of the recent numbers versus, I would call it a decreasing risk of an inflationary impulse just based off of where the oil price is today. I think that $90 level for oil is an important pivot point. The further below 90 that we go definitely maintains rates where we are. If we go below 80, I think there's eases back on the table. Above 90, they want to maintain their optionality. And I think above $100, hikes are definitely a stronger possibility.
Yeah, and the central bank says noted there's been limited evidence of broad-based pass-through of higher energy prices to other prices. But the governor said oil prices remained elevated, and the price of a barrel is roughly $10 higher than the central bank assumed in its April monetary policy report. So that if things aren't resolved in Iran, this pushes into the summer, into the fall. It's possible into the fall, especially before anything is actually resolved and things are back to normal. What kind of pressure does that put?
I do think there's more certainty that comes through in regards to inflationary aspects. And the reason why I think that, what the Bank of Canada just said in that statement is very true. Limited evidence of pass-through of higher oil prices. Having said that, if there is no resolution to the Iran-U.S. crisis/war, what happens is there's non-linear effects on inflation. It means inflation spikes. It doesn't just rise gradually. And the reason why that is right now, globally, there is still oil reserves in countries. And that's what the individual countries are using to help temper and tamper down the price of oil locally for consumers. We're coming very close to those oil reserves running out. Once they run out, that's when you see a jump in oil prices. So I think the next 2 months or next month, even from a resolution perspective, is very important because the expectation would be the pass-through would come through if there's no resolution by, call it, August. And that's where the risk is from a Bank of Canada. I have to apologize before for interrupting you. The volume here isn't that great, so
no
my
worries.
Apologies for that.
Everything's just kind of coming down as we were talking to, so I've been jumping around a little bit as well. The bank also commented on the GDP and said that while growth appears on track to resume in the second quarter, it expects the economy to remain in excess supply. And of course, I imagine CUSMA is a potential factor for that as well.
Yeah, and so that's definitely a factor from not necessarily the immediacy of impact on the economy, but from an investment, from a higher level of confidence as to where we'll be in 2027, 2028 with more investment. A lot of the large international companies are, I would say, still in the consideration mode of putting significant investment in Canada because they don't understand the rules of engagement with the U.S. So that's an important part there. So I think that's key to keep in mind. Another thing that you just mentioned, which is very important to me, that they mentioned the word excess supply. Excess supply is the counterwind or headwind to inflation. It helps keep inflation lower, helps lower the pass-through. So that's an important aspect for the Bank of Canada. Again, this says why they're in that dilemma. They got so many things on both sides of the choice of easing or hiking, that's why we believe they will remain unchanged for the balance of the year.
And you mentioned earlier about keeping an eye on the U.S. What factors down there are the biggest things, do you think, putting pressure on either a hike or a cut either way, especially with the new Fed chair?
Yeah, the number one factor is employment. A reason why, because the economy has been going economic-wise, they've had economic surprises to the upside all year in the U.S. There's two underlying reasons for that. One is the tax refunds due to the big, beautiful bill. That has stopped now, so it'll be interesting to see if they maintain that level of growth. The other one, the very important one, which people don't talk about a lot, is the big deregulation move under Trump. That takes away a lot of business friction, allows the smaller and medium-sized businesses to grow, and that's supportive of employment. It's not your Amazons and your Microsofts and your Metas who are your large U.S. employers. It's actually all the small and medium-sized businesses. That's 70-80% of employment in the U.S. So the important thing to look at in the U.S. is employment, because the reason why they had eases on the table and an easing bias, there was only one reason. Well, there's two reasons. But the economic reason was employment was slowing. And that was important. That's why they said we need to ease insurance cuts. We need to keep employment going. That's transitioning. The other reason is the thumb of President Trump on that scale as well, too. But with the strong employment number that we've seen last week, if that continues, it's going to be very difficult for them to maintain their easing bias. The market is actually discounting hikes in the U.S. now, where prior was earlier in the year is discounting eases. We think that's more likely to be realized than a hike in Canada.
All right, and you said hikes in the U.S., so you think we could see more than one?
Yeah, they're discounting, and the market is discounting one hike in the U.S. by the end of the year. Like I said, earlier on this year, they were discounting up to 2 eases by the end of the year. That has been different from Canada, which has been discounting hikes by the end of the year all year. The reason of the difference is Bank of Canada has a single mandate, inflation. So based off the war, higher oil, from that mandate, it says theoretically they should be hiking. The U.S. has two mandates. Inflation is one and employment's the other. So now that inflation is pointing towards a hike, employment was pointing towards an ease, now that's starting to point towards a hike as well.
All right, we've got to go on that note there. Let's talk again in 6 weeks and see where we're at. We appreciate the chat. Thanks very much for joining us.
Thank you.
Earl Davis, head of fixed income and money markets at BMO Global Asset Management. And that's Thanks very much for him joining us. We'll get more from the Bank of Canada at 10:30 a.m. Eastern Time, 7:30 a.m. Pacific, when BOC Governor Tiff Macklem and Senior Deputy Governor Carolyn Rogers hold their news conference, and we'll take questions from the media. Coming up, turn our attention back to the markets and see how Bay Street is reacting to the BOC decision. All right, let's take a quick look at the markets, and we'll start with the Canadian dollar, seeing where it's at with the news from the Bank of Canada holding pat. No real surprise. It's up by about 0.25% right now at 71.86. Still down slightly from what we saw earlier, but still up for the day. All right, taking a look at the TSX. And it's pulling back up. It's clawing its way back up. And it's still down by 0.1%, but let's see how the financial sector is doing. We heard some news from RBC about planning to hire and U.S. expansion. And right now, the financials are up by about 0.25%. And taking a look at some of the individual banks, see how they're doing right now. You got TD up by 0.4, RBC by 0.7, and the Bank of Nova Scotia by about 0.25 point. So they are pulling the markets up. We'll see how it ends for the rest of the day. And BMO also in the green, National Bank and CIBC as well. Coming up, we'll get more insight into today's Bank of Canada decision with Jeremy Cronick, President and CEO of the C.D. Howe Institute, after our central bank held its policy rate steady this morning. More after the break. Welcome to the second hour of The Open. Let's take a look at some of the stories we're following in the BNN Bloomberg newsroom. The Bank of Canada has left its key rate unchanged at 2.25%. No real surprise. Governor Tiff Macklem says economic weakness combined with rising inflation is a dilemma for monetary policy. He reiterated that the central bank may need to cut or hike rates consecutively depending on how risks unfold, citing U.S. trade uncertainty and the war in Iran. The BOC notes, however, that while growth appears on track to resume in the second quarter, it expects the economy to remain in excess supply. U.S. inflation continued to climb last month. The Consumer Price Index jumped 4.2% in May, three-year high, and marking the third consecutive monthly increase since the start of the Iran war. The rise in inflation largely driven by energy prices, which accounted for 60% of the overall increase. The conflict in Iran is fueling concerns that the surge in oil prices could spread to other energy-sensitive parts of the economy. Apotex has raised $1.3 billion in its initial public offering. It's Canada's largest since 2021. The generic drug manufacturer priced its IPO at $24 per share. The listing comes nearly a decade after the murder of Apotex founder Barry Sherman and his wife Honey. The company was sold in 2023 to New York-based SK Capital Partners. And taking a look at the markets right now, you can see it's clawing its way back, still off by 0.14%, but on the whole now it's down. You can see it might maybe end up in the green today. It's a whole toss-up right now. It's being dragged down by tech and materials. Energy trying to pull it up south of the border. Things are a little calmer there, still off. The S&P 500 down by 0.22, NASDAQ by 0.35. Concerns tech, overinflated maybe, and of course what's unfolding in Iran, uncertainty there. As expected, the Bank of Canada held rates steady despite headline inflation being near the upper end of the central bank's inflation target. While the ongoing conflict in Iran continues to push prices higher, our next guest says deciding to hold was the right call. Joining us now, Jeremy Cronick, President and CEO of the C.D. Howe Institute. Jeremy, thanks very much for joining us.
Thanks for having me.
All right. Was there really anything else they could have done at this point?
No, I don't think so. I think the data makes the case for a hold. So on the one hand, you've got core inflation measures that are coming down to 2% to the target, which is great. But on the other hand, you've got industrial prices that are increasing. You've got a weak economy. So you've got sort of these conflicting data points that suggest that holding the overnight rate was the right decision.
And it really is a conflicted situation right now. I mean, they're getting pulled in both directions, talking about potential hikes and potential cuts.
Yeah, that's right. So the industrial production or the industrial product prices that I was just mentioning, that level of increase, we haven't seen double-digit growth like that since the post-pandemic surge. And those prices will get passed on to consumers. But at the same point, you're seeing core inflation measures come down. You're not seeing the oil price shock spread as much to other prices as you might have thought. And so in that kind of environment, you're best off if you're the bank holding the overnight rate where it is. Even the sort of GDP data is mixed, right? So we've been talking a lot about whether we're in a technical recession or not. The Institute has a business cycle council that says, well, let's hold off and not jump to that conclusion just because of the 2 quarters of GDP growth. But even with that, you had decent employment data in May. You've seen consumer spending in those Q1 numbers, be higher than expected. So there is some spending still happening in the economy. So you got a lot of conflicting data to deal with.
Just going to the jobs for a second, for example, that some have said those hirings were in the service sector, and it's all because of the FIFA World Cup coming to Canada. Is that how you're feeling with it?
I don't know about that. I mean, the full-time hires were elevated in May, and a lot of the job loss that we saw in the first few months of the year has been, we captured that in May. So I don't think that the FIFA World Cup is enough of an explanation. But I also don't think that that catching up to the losses from the first few months of the year is enough to say that we're in good shape moving forward. There's a lot of uncertainty on the horizon. Obviously, with the CUSMA review, business investment remains weak in part because of the uncertainty around trade. So, there's a lot of indicators that suggest there's still some weakness despite that boost in employment.
And with CUSMA, I mean, obviously, getting it resolved faster is better. But what happens? I mean, have you looked at what happens if, say, we have a deal again, like it's similar to what we saw, or maybe we end up negotiating separately with the U.S. from Mexico? What kind of an impact do those have, and then what do they have on the Bank of Canada?
Well, I mean, I think that the part of the story right now seems to be that it's unlikely we're going to end up with an agreement, by July 1st. And even if we do end up in an agreement, there's probably going to be some level of tariffs. I think at this point, maybe what's most important is just to get some certainty on what that's going to be. I mean, so much of the last year has been moving back and forth between higher tariffs and lower tariffs, and it's going to cover this good and that good, and Supreme Court decisions, et cetera. And so just getting certainty on what the plan is, I think will at least allow businesses to invest, knowing that there's some stability, even if that stability is not the first best solution.
And we've talked about, businesses holding off because they're of the uncertainty. Do we know for sure they're holding off, or is it maybe there isn't the money there or there isn't the plans there, that they don't plan on doing any growth?
Yeah, I mean, so I think there's maybe a few things at play. There's this uncertainty that's come about through trade, but there's also some structural barriers in Canada that the government's been working on removing. Right, so the Major Projects Office is an example of an attempt to remove some barriers that have created that uncertainty in the past. I mean, I think it's there for the right projects and the right scenarios, and with the belief that you're going to be able to invest that money and see that return. So creating that certainty both through the international side, but also through our own decisions is critical.
And with oil and the Middle East, how much of a factor? A lot of the oil shock has been absorbed because of reserves. Those are being drawn down. If there's no resolution, how does that play with the bank?
Yeah, so I mean, I think that's the geopolitical story. The war in Iran is a huge part of where we go from here, right? So I mentioned a couple times now that the industrial price index being quite elevated. Now, if there's a deal on the war in Iran, and if we are able to get supply chains restarted and get things back to normal fairly quickly, then perhaps those industrial prices will come down and less of it will be passed on to consumers. However, if there isn't a deal, and if supply chains take a long time to get restarted, or they've been diverted and there are issues there, and it becomes longer lasting, if inflation expectations start to become more de-anchored than they have been, well, then certainly the bank does have to react and consider tightening.
But for now, it sounds like it's a lot of sitting. I think how long do you think they're going to sit before they have to make a decision one way or the other? As long as they can?
I mean, that's a good call. Yeah, I mean, so inflation expectations have been fairly well anchored. And so that in part that's because of the credibility of the bank's been built up over many, many years. So they probably have a little bit of time to work with. I think people understand that this is a somewhat localized shock in terms of the sectors that it affects, but it'll really depend, I think, on how and whether the bank starts to see these inflationary pressures spread to other sectors, and we haven't seen that quite yet.
All right, Jeremy, thank you very much for joining us today. We appreciate it.
Okay, thanks for having me.
Jeremy Kronick is president and CEO of the C.D. Howe Institute. Coming up, as FIFA World Cup fever ramps up across Canada, the country's largest city is planning a big concert that will connect Toronto to simultaneous live shows in Mexico City and LA. More on that next. World Cup fever is growing, and so too is Toronto's budget to host the FIFA World Cup. $380 million, $153 million of that is for capital costs, which includes stadium upgrades. BNN Bloomberg has obtained a detailed breakdown of the renovation costs, revealing how much was spent on each upgrade and whether those investments will keep paying dividends long after the final match. Lindsay Biscaya has more on this.
Usually known as BMO Field, Toronto Stadium is now ready to host one of the world's largest sporting events.
We're in the tunnel right now, which is an unbelievable place to be. This is where the teams will line up before they go onto the pitch. And so we've had to widen the door here to ensure that there's a big, beautiful, wide broadcast shot of those players and the kids coming out onto the field and then walking into what is going to be an unbelievably packed and really amazing football stadium for the World Cup. So can't wait to see it in action.
2 years of work in the making for the 6 group stage matches that will be held in Toronto. The city spent more than $132 million on upgrades, while MLSE contributed $25 million for a total of $157.9 million. Many of the upgrades are requirements by FIFA, including adding 6 lockers to the change rooms for a total of 26 lockers. There are also new LED video boards, one in each corner of the stadium, and audio and technology upgrades. There are new hospitality suites, which is one of the bigger permanent components, as well as upgrades to the restrooms. And there was also modernizations to the stadium lighting to match FIFA's television and broadcast requirements, and brand new turf.
We did. We were one of the very few stadiums hosting the World Cup this summer with natural grass. In fact, FIFA came through years ago and they said, you can host a match right now because they love the pitch that we already had. But as mentioned, we wanted to have the absolute utmost quality for a World Cup.
Stephanie Jones with Maple Leaf Sport and Entertainment says the grass was grown in a greenhouse by Green Horizons and was laid down on site in late 2025.
We laid down the sod in November and December and then stitched it all together. So we've got 5% of stitching amongst all of the blades of grass, but we're ready for it.
There was also an upgrade to the video production control room and public announcement systems.
And one of the largest broadcast compounds we've ever built in sports in Canada is built on the south side of the stadium.
Additional costs included pre-construction and soft costs, as well as direct costs for insurance, equipment rentals, demolition, and mechanical work. And the biggest expense of all, the temporary grandstands. 17,000 seats have been added to this stadium, which is a requirement set by FIFA. Just to host the group stage events, the threshold is 40,000 seats. So here at Toronto Stadium, that's an extra 10,000 seats added to the north end and another 7,000 seats added to the south end. It's a lot of work and a lot of money. And so the question has to be asked, was all of this worth it? What's the long-term return on investment?
What is important about those infrastructures, and different folks will talk about it here, is it allows them to continue to bid for more things moving forward.
Sherry Bradish is the director of the Future of Sport Lab at Toronto Metropolitan University. She says the investments will help to build Toronto's legacy as a city that can handle hosting mega revenue-generating events.
I think what we're going to see in Toronto is definitely a long tail of legacy. And I think it will be more in programs we're going to start to see roll out attached to soccer pitches across the country. What you want to ensure is that the venue and the infrastructure that you're committing has a legacy plan for the citizens.
The city, the teams can't sort of sustain a 45,000 seat stadium at this time. And so that's why we went with temporary seating. There are a number of things that we're doing at the stadium that are actually legacy projects. So the new video boards, new lighting, new audio, new pitch, new concession stand, technology, et cetera, that will all be legacy items that, improve the fan experience and the broadcast experience long after the tournament is over.
The big FIFA stress test happened about a month before the World Cup, when TFC welcomed Inter Miami to the stadium. MLSE was confident it would be a sellout crowd for one reason and one reason only: Lionel Messi.
It's really about people movement. That's the test. Everything else, we know how to operate a stadium, but now we have to look at operating at 45,000 capacity.
A sellout crowd of 44,828 fans, including about 17,000 spectators in the new grandstands. Some seats remained empty at kickoff, though, as fans were still making their way into the venue and through the concourse. It's a problem that was quickly addressed. In a statement to BNN Bloomberg, MLSE says, as with any review, we identified areas for improvement for wayfinding and continued optimization of concourse line management. We asked MLSE whether there would be additional costs associated with the tweaks, but the organization would only say final project costs will be confirmed by the city. Not only did the game serve as a live preview of World Cup-level venue demands for the city and MLSE, but with the stands full of buzzing fans, it offered a snapshot of just how much of an economic lift these games could be for the city and the country, and the legacy that could follow.
And that was BNN's Lindsay Biscaya. Now, as the FIFA World Cup fever ramps up across Canada, the Countdown concert is set to rock Canada's biggest city tonight, a 90-minute set featuring some big names. For more on the show, we're joined by CTV's Renee Rogers. Renee, thanks very much for joining us. Are you ready for the show? Who's playing tonight?
Oh, it is set to be quite a big show, Roger. It's really the kickoff to the celebrations when it comes to the 2026 World Cup. And FIFA is calling it a first-of-its-kind concert. And that is because the concert that is taking place in Toronto is set to be simulcast with two other concerts, one happening in LA and the other happening in Mexico City. And FIFA says that this simulcast event will, quote, unite three cities, three countries, and the world through the universal languages of music and football. Now, Toronto's lineup features Bryan Adams, who will be joined by other Canadian artists, including Nora Fatahi, Wyclef Jean, and The Beaches. Now, this concert will be broadcast tonight from 9 to 10:30 Eastern Time. Tickets are still available, but if you can't make it in person to Fort York and the Bentway, you can tune in through FIFA's global broadcast and digital channels. There's also a live stream of this, Roger. It is on the FIFA World Cup 2026 official TikTok account. You'll be able to view it there as well, once again, starting at 9 o'clock Eastern Time.
All right, sounds like it should be a good party. And what are the other shows? Who is Wyclef Jean playing up here?
He will be playing in the opening ceremonies of the matches as Canada gets ready to play its first ever Men's World Cup game on Canadian soil. It'll be the first of 13 games that will be played here in Canada, with the first one, as we know, being at Toronto Stadium against Bosnia and Herzegovina. And something kind of interesting, Roger, is that the Bosnian Canadian Association is projecting that roughly 25,000 Bosnian fans and members of the diaspora from across the globe, as far away as Australia, will be in the Toronto area to cheer on their team. There are different viewing parties that are being held all around. But that being said, Roger, something interesting, we are getting some data about hotel bookings in both host cities, Toronto and Vancouver. It comes to us from hotel analytics firm CoStar. It tells us that as of July 1st, hotels in both of those host cities are less than half booked on the game days. So there is some hope, though, that there will be some last-minute bookings. And there's also some indications that the Airbnb business, those short-term rental businesses, are picking up some of the visitors as well. So it'll be interesting to see how this all shakes down with such a surge predicted in the hotel industry.
All right, we'll wrap it up there. Renee, thank you very much for that. We'll be maybe watching the show a little later. CTV's Renee Rogers. Coming up, we'll take a look at a few of the notable calls for today, including Canadian Tire. Time to take a look at some notable analyst calls and recommendations, and we'll start with a Canadian classic, Canadian Tire. Stifel Canada initiating coverage with a recommendation to buy. PT set to 215 Canadian, implying a 19% increase from last price. Canaccord Genuity initiating coverage of Hemlo Mining with a recommendation of buy. PT set to $11 Canadian, implying a 78% increase from last price. Raymond James analyst Timothy Thane raising the target on United Rentals to $1,275 from $1,100, maintaining an outperform rating. The new PT implying a 17% increase from last price. Oppenheimer lowering the firm's price target on A.O. Smith to 75 from 80, keeping an outperform rating on the share. Although growth is likely to remain challenged over the near term, Oppenheimer says it believes A.O. Smith's replacement-weighted revenue, cost initiatives, and balance sheet/portfolio optionality remain supportive of stronger growth and profitability looking forward. And coming up, we'll have a news conference from the Bank of Canada shortly. The Bank of Canada has left its key rate unchanged at 2.25%. Governor Tiff Macklem says economic weakness combined with rising inflation is a dilemma for monetary policy. He reiterated that the central bank may need to cut or hike rates consecutively depending on how risks unfold, citing U.S. trade uncertainty and the war in Iran. BOC notes, however, that while growth appears on track to resume in the second quarter, it expects the economy to remain in excess supply. The head of Cenovus is calling a plan for a massive carbon capture project uneconomical. Pathways carbon capture project is considered a central condition for new oil infrastructure. However, CEO John McKenzie says the plan doesn't address how the industry would ship an extra 1 million barrels of oil a day while also spending capital on the Pathways project, a project he says would cost as much as $30 billion. Apotex has raised $1.3 billion in its initial public offering. It's Canada's largest since 2021. The generic drug manufacturer priced its IPO at $24 per share. The listing comes nearly a decade after the unsolved murders of Apotex founder Barry Sherman and his wife Honey. The company was sold in 2023 to New York-based SK Capital Partners. And a quick look at the markets right now. And you can see TSX is kind of clawing its way back up towards at least a wash. It's down by about 0.07 right now after starting off further down than that this morning. But bouncing back a little bit. The NASDAQ, let's take a look at that and see where we're at with it and the S&P 500. And the NASDAQ, again, same thing. It's kind of pulled its way back up to about a wash right now. There were concerns over a bit of a tech sell-off. That's maybe calming down. The inflation has settled things down a little bit as well, seeing those numbers. That has helped. And, of course, there is the concern in Iran. The S&P 500, and we'll take a look at that and see where we stand. And the S&P 500, similar situation. It's kind of pulled itself back up almost to a flat day. The Dow now, and it is off by a half point. We'll see where that goes, but still well above 50,000. Looking at oil now with everything that's unfolding in the Middle East, concerns that maybe the truce is fraying. Oil is up slightly, 1.72%, but still below $90 a barrel. And gold, we'll take a look at that. It has been in a bit of a free fall. That continues now well below 4,200, off by almost 2.5% right now. And you can see the big drop it's taken since March and the war. And one quick look at the loonie before we head over to Ottawa. And the loonie is up by 0.18%. Okay, let's go to Ottawa now, where the Bank of Canada Governor Tiff Macklem and Senior Deputy Governor Carolyn Rogers are holding their news conference about their hold on the rate.
Good morning, everyone. Welcome to the Bank of Canada and this morning's press conference about today's interest rate announcement. Governor Macklem will have some opening remarks, and then he and Senior Deputy Governor Rogers will be happy to take your questions until about 11:15. Le gouverneur Macklem va prononcer une déclaration préliminaire, et ensuite on va tourner aux questions.
And then we will move on to questions. Over to you, Governor.
Good morning, everyone. We're very pleased to be here together to discuss today's monetary policy decision. Today, the Governing Council maintained the policy interest rate at 2.25%. Since our April decision, the economic impact of the ongoing conflict in the Middle East has increased. Higher energy prices and disruptions in global supply chains are weighing on global growth and pushing up inflation worldwide. At the same time, the U.S. administration continues to propose new tariffs, and trade policy uncertainty remains elevated. Against this backdrop, the Canadian economy has remained soft and inflation has increased. Monetary policy continues to be focused on ensuring that higher energy prices do not turn into persistent inflation, while helping the economy adjust to headwinds. We are committed to keeping inflation low and stable over time. The
Governing Council maintained the policy interest rate at 2.25%. Since our April decision, the economic impact of the ongoing conflict in the Middle East has increased. Higher energy prices and disruptions in global supply chains are weighing on global growth and pushing up inflation. At the same time, the American administration continues to propose new tariffs, and trade policy uncertainty remains elevated. Against this backdrop, the Canadian economy has remained soft and inflation has increased. Monetary policy continues to be focused on ensuring higher energy prices do not turn into persistent inflation, while at the same time helping the economy adjust to headwinds. We are committed to keeping inflation low and stable over time.
So let me expand on what we're seeing since the April Monetary Policy Report and the implications for monetary policy. The conflict in the Middle East is slowing economic activity in the Gulf region and in many oil-importing countries, and sending inflation higher worldwide. At the same time, AI-related investment is boosting growth in the United States and some Asian economies, and equity prices have been buoyant. In Canada, GDP edged down 0.1% in the first quarter, weaker than expected at the time of the April report. Consumer spending grew by 1.4%, but there was an unexpected pullback in government spending. Housing activity also declined, and business investment remained weak. While the labor market strengthened in May and the unemployment rate fell to 6.6%, there's been a lot of volatility in the monthly job numbers. When you look through the bumpiness, employment in Canada is little changed since the start of the year, and the unemployment rate has been fluctuating in the 6.5% to 7% range. Recent data suggests GDP growth will resume in the second quarter, with continued increases in consumer spending and more stability in the housing market. Even with some rebound in GDP growth, we expect the economy to remain in excess supply. As anticipated, CPI inflation rose in April, reaching 2.8%. The increase reflects energy prices, both higher global oil prices and the impact of the elimination of the Canadian consumer carbon tax falling out of the 12-month rate of inflation. So far, there's been limited evidence of broad-based pass-through of higher energy prices to other consumer prices. Measures of core inflation have moved down to around 2%, and the share of CPI components growing above 3% is close to its historical average. Food price inflation moderated but remains high, and shelter inflation continued to slow. With the conflict in the Middle East persisting, oil prices have remained elevated. Market expectations have shifted up since April, and oil prices are roughly $10 a barrel higher than we assumed in the MPR. Based on this, we expect CPI inflation to hover close to 3% in coming months before easing gradually towards 2%. We'll be watching closely for evidence of a broadening in price pressures. The bank is committed to keeping inflation close to the 2% target over time. At our meeting this week, we decided to maintain the policy rate at 2.25%. Governing Council agreed to look through the war's near-term impact on inflation, but if energy prices stay high, we will not let their effects become broad-based, persistent inflation. Un ralentissement économique combiné à une montée.
Economic weakness combined with rising inflation is a dilemma for monetary policy. Raising rates to dampen inflation could further slow the economy. Easing rates to support growth increases the risk that higher inflation becomes persistent. For now, holding the policy rate unchanged balances those risks. However, uncertainty is unusually elevated, and the risks could shift. Monetary policy may need to be nimble. If the United States imposes significant new trade restrictions on Canada, we may need to cut the policy rate further to support economic growth. Alternatively, if the conflict in the Middle East continues and higher energy prices start leading to ongoing generalized inflation, monetary policy will have more work to do. That may need consecutive increases in the policy rate. Of course, these are not the only possible outcomes. The Canadian economy is working through a period of structural change.
Economic weakness combined with rising inflation is a dilemma for monetary policy. Raising rates to dampen inflation could further slow the economy. Easing rates to support growth increases the risk that higher inflation becomes persistent. For now, holding the policy rate unchanged balances those risks. However, uncertainty is unusually elevated, and the risks could shift. Monetary policy may need to be nimble. If the United States imposes significant new trade restrictions on Canada, we may need to cut the policy rate further to support economic growth. Alternatively, if the conflict in the Middle East continues and higher energy prices start leading to ongoing generalized inflation, monetary policy may have more work to do. There may be a need for consecutive increases in the policy rate. Of course, these are not the only possible scenarios. The Canadian economy is working through a period of structural change. Shifting trade relationships, the adoption of AI, and changes in demographics complicate the assessment of the economy. We're going to be watching all these developments closely and assessing their implications for growth and inflation. And as the outlook evolves, we stand ready to respond as needed. The bank is committed to ensuring that Canadians continue to have confidence in price stability through this period of global upheaval. And with that, the two of us would be very pleased to take your questions.
Okay, thank you, Governor. We will go to questions now. We'll start with the reporters who are here in Ottawa at the bank, and then we'll go to those who have joined us remotely. As usual, I'm going to ask you to please limit yourself to one question so that every media outlet has the chance to participate. If I forget to do so, please state your name and affiliation. Avant de poser votre question, veuillez vous identifier si j'ai l'oublié de.
Please give your name and affiliation before asking your question, and of course, you are able to ask questions in the language of your choice.
I'm going to start with David Lundgren from Thomson Reuters, please.
Governor, good morning. You say you're going to look through the near-term impact of energy prices lifting overall inflation, but at what point do you stop looking through the near-term impact? Is it 1, 2, 3, 4 inflation prints in a row that you don't like, or suddenly the number spiking?
David, it's less about a timeline, and it's more about the conditions. So what are the things that we're going to be looking at? What we don't want to see is the big rise in energy prices turn into generalized inflation, and then we don't want that to become persistent inflation. So how do we assess generalized? Right now we're seeing very limited evidence of pass-through of higher energy prices to other goods and services, the prices of other goods and services. Obviously, you can see some effects. You're seeing surcharges on airlines, for example. But broadly, you're not seeing much pass-through. How do we assess that? Well, core inflation, which strips out the increase in energy prices, it's actually ticked down. If you look at the proportion of CPI components that are rising faster than 3%, it's close to its historical average. So far, there's very limited evidence. But if we started to see more evidence that higher energy prices were passing through to other goods and services, that would certainly get our attention. That would be a source of concern. And then, yes, the other thing you look for is persistence, and there, things like looking at inflation expectations. Naturally, with higher inflation, near-term inflation expectations have gone up. Inflation has gone up, so of course, near-term inflation expectations have gone up. So far, we're seeing longer-term, medium-term inflation expectations are remaining well anchored. But if you started to see those drifting up, that would be a sign that inflation is becoming entrenched, and it's going to, the persistence is likely to go up. So those are really the things we're watching for. It's less about the timeline; it's more about the conditions.
Okay, let's go to Paul Vieira from the Wall Street Journal, please.
Good morning, Governor. U.S. inflation rose past 4%, according to data released this morning. Why do you expect inflation to be more muted here at around 3% in the coming months? Is it because the economy is that much weaker and there's more slack or spare capacity than originally believed?
Well, that's certainly part of it. I think, just to back up for a minute, part of it is that, we started with 2% inflation. Inflation until the war in the Middle East was running close to 2% for more than roughly a year and a half. So we had inflation back to target. It has moved up, but it started lower, so it's still lower than the United States. There are some other factors pushing inflation up in the U.S. There's no question U.S. tariffs have boosted U.S. inflation. That effect is probably going to start to wane unless they take new trade actions. And as you said, as you mentioned, yes, the Canadian economy is soft. It's weak. And that tends to put a downward pressure on prices generally. As I said, we have not seen any evidence yet of broad-based pass-through of higher energy prices to other goods and services.
All right, next on the list I have Kevin Carmichael from The Logic, please.
Good morning. I'd like to try to get you to say a little bit more about what the GDP miss has done to
the way you're thinking about the economy now and going forward? I mean, that was quite a big miss. Does that alter your estimate of slack in the economy, and therefore should we assume the normalization phase is going to be longer than we might have thought a few months ago?
Well, I'll dig in a little bit on the GDP number in a minute, but I mean, big picture, not a great deal really has changed since our last decision. The war in the Middle East is still ongoing. Uncertainty about U.S. trade policy remains. The review of CUSMA is ongoing. And the data overall there have not been big surprises. Yes, fourth quarter GDP was quite a bit weaker than we thought. But if you look under the hood, I mean, consumption grew 1.4%. You're still seeing consumer spending expanding. The miss was largely because there was an unexpected pullback in government spending. It can be difficult translating. Government spending can be choppy one quarter to the next. We don't think there's any sort of ongoing shift in government spending. The government have announced their plans. We built those plans into our projection. Figuring out exactly how that plays out quarter to quarter is difficult. You look at Q1, so consumption was fairly healthy. Housing housing declined. Business investment was soft. And then, trade and inventories were largely a wash. That gave you, a very slightly negative quarter. We do think growth will resume in the second quarter. We expect to see, continued expansion of consumer spending. We think there'll be a little more stability in the housing market, so it won't be subtracting from growth. So we do expect growth to resume. And if you look at the labor market, month to month, there's been a lot of volatility in employment. Last month was up strongly. If you look over the last 6 months, basically employment is roughly unchanged. The unemployment rate's been fluctuating in a range of 6.5% to 7%. So that hasn't really changed since last time.
Okay, we'll work our way across the room here. Now let's go to Craig Lord from the Canadian Press, please.
Good morning, governors. Thank you for taking our questions. I appreciate the details of the analysis of the Q1 GDP figures there, but given the conversations for the past 10 days, I do have to ask, do you believe Canada's in a recession right now?
Look, the short answer to that question is, based on the data we've seen to date, the economy is weak, but it is not clearly in recession. So let me just unpack that a bit for you. If you look at how the economy has evolved over the last year, GDP is roughly flat over the last 12 months. If you look at the labor market, it's up a little bit over the last 12 months, essentially flat over the last 6 months. As I mentioned, there's been a lot of volatility, month to month, quarter to quarter. But when you look through the bumps, I mean, the economy hasn't really grown in the last year, but it hasn't shrunk either. So, economists typically define a recession as a significant broad-based decline in economic activity that lasts for more than one quarter. And if you look at the data we've got, as I said, based on the data we've got, based on that definition, the economy it's weak, but it's not clearly in recession. If you look at the first quarter was just barely negative after the decline in the fourth quarter of last year. If you look across industries, what you see is that in the first quarter, more than half of industries actually expanded on a year-over-year basis. And as I mentioned, the unemployment rate's been relatively stable in the 6.5% to 7% range. So far, we have not seen a significant broad-based decline in economic activity. So I wouldn't, recession is not the word I would use. I would describe the economy as weak. It hasn't grown really in the last year. There's excess supply in the economy. There's slack in the labor market. We're certainly assessing that closely, and as we indicated, we're prepared to respond as needed.
All right, we'll call on Greg Quinn from Market News, please.
Good morning. In the last decision, there was a
a reference to being able to keep the policy rate about where it was if assumptions on oil prices and trade were met. I didn't see anything so explicit in this statement. Are you trying to tell us that it's becoming unlikely that the economy can get through this awkward phase on its own without some kind of change in monetary policy?
No, I mean, we're continuing to balance both risks we've described. The oil risk is one risk. If we see oil prices increase further, if we see them sustained at a very high rate, and most importantly, as the governor just described, if we see that start to feed into broader base price increases, that's a risk we'll need to react to. On the other hand, we still have this trade uncertainty overhang in the economy that could weigh on growth. We could get further trade action. We could get further deterioration from the sense of uncertainty we have. That's a risk we'd have to react to as well. What we're telling you today is we see those risks continue to be about where we saw them last time. The economy continues to be about where we thought it was last time, which means we've got the rate where we think it needs to be right now. We've got a forecast in a few more weeks, and we'll be taking all the data in and see where we're at then.
All right, next I'll go to Mark Rendell from the Globe and Mail, please.
So we have the upcoming review of the CUSMA USMCA. It seems like all three countries have said at this point they don't expect anything to be finalized on July 1. So we could be in a period of kind of extended uncertainty about the trade relationship. How are you guys thinking about that? Is that period of an extended uncertainty kind of the downside risk you point to here as a potential reason to cut rates? What could we look like if we don't get any kind of certainty in the coming month or two?
Yes, as you've indicated, I mean, what all parties are indicating is that discussions are ongoing, negotiations are ongoing. They're probably going to play out over a number of months. So yes, that uncertainty will continue to weigh on the economy. I think the good news is with the exception of the hard-hit sectors, the vast majority of goods that are traded with the United States continue to be traded tariff-free. I think businesses are starting to recognize that our trade relationship with the United States it's changed, and that uncertainty. It's even with the deal, I don't think you can be certain about anything. Businesses are having to adjust to that. You're seeing, they're adjusting to that uncertainty. They are diversifying their trade. They're also, to some extent, just getting used to the new reality and getting on with business. If you look at our last Business Outlook survey, you could see that in the responses of businesses. Even though the uncertainty had gone away, they were starting to make investment plans. I'm not saying the uncertainty wasn't weighing on them, but they were starting to sort of recognize, okay, we can't just sit on our hands forever. This isn't going away. We've got a business to run. We've got to manage in an environment of uncertainty, and you're starting to see businesses get on with it. So we are expecting to see, at least in our last projection, as Senior Deputy Governor mentioned, it will be updating that in our July projection, and we'll be getting a new Business Outlook survey as well. So we'll see how things are evolving. But I mean, based on the last one, we have some modest pickup in business investment going forward after a lot of weakness.
All right, I've got a couple more questions here in Ottawa. Let's go to Najoud Almalis from Bloomberg, please.
Good morning. I wanted to ask about the risk of higher energy prices feeding into generalized inflation. As you mentioned, core measures of inflation eased in April, but at the same time, you mentioned how oil prices are higher than the central bank was assuming in April. So I guess I'm wondering if you're more or less concerned today about that risk compared to April.
Well, look, I mean, the war in the Middle East it's still going on. There's no clear resolution in sight. We don't know what that resolution would look like. There's been damage. So yes, this is probably, the fact that the energy price futures curve has shifted up, I think is reflecting that. And look, the longer this goes, the higher energy prices are, the longer they're higher, the bigger is the risk that starts to pass through to other goods and services. And, the more likely that becomes that then, we need to respond. So that is certainly a concern. And, we've been very clear. We're not going to let war in the Middle East become an inflation problem here in Canada. But that's not the only thing going on. There is a lot going on. We've been talking about trade. Canadian economy is going through a period of restructuring, adoption of AI, lower population growth. So we got to look at all these things together. And we'll be updating our forecast and taking our decisions based on our assessment of where inflation's going, how the economy's doing.
Okay, and our final question here in the room is from Mackenzie Gray of Global, please.
There's two competing risks, the inflation risk, of course, and the trade concerns that you've talked about that could send monetary policy in two different directions. What do you view as the bigger risk to the Canadian economy?
Both is the short answer. That's the reason we're talking about both of them. Look, clearly, as I've just said, clearly, war in the Middle East, it's ongoing. The longer it goes, the higher energy prices are. And in particular, the longer they stay high, that risks a one-off increase in energy prices becoming more persistent inflation. That's what we can't let happen. We were committed to getting inflation back to our 2% target over time. We're prepared to look through the near-term impacts, or what you might call the first-round impacts. But when you start to see second-round impacts, you start to see more persistent. That's certainly a signal that monetary policy has more work to do. But yes, look, trade remains very uncertain. The discussions, the negotiations remain ongoing. Hopefully that lands well. And the Canadian economy can, we can restore more certainty in our relationship with the United States. You can see, and I think if that happens, you'll see more strength in exports, more strength in investment. That'll be good to the economy. But look, we have no influence on that outcome. We're going to take things as they come. There are risks on both sides. They're both important.
Okay, we'll go to those reporters who have joined us remotely now. I'm just going to remind you folks on the line, come off mute only to ask your question, then go back on mute as soon as you've finished so everyone can hear the response. I've got three folks on the line. First, I'm going to call on Anna Pereira from the Toronto Star. Go ahead, please, Anna.
Hi, good morning. Governor, you said several times that you expect growth to resume, but given your recent GDP miss, I have to ask, what is the evidence backing that belief? Are you expecting a resolution to the CUSMA negotiations anytime soon? Can you just give us some color on that?
So, look, our base case on CUSMA is that the negotiations continue to play out for a number of months. We haven't built in a big change one way or the other there in terms of our outlook. In terms of what is the evidence for the second quarter, we do have some higher frequency indicators for the second quarter, which can give you some advanced perspective on where it may land. If you look at things, so there's a flash GDP estimate for StatsCan that was fairly positive for the first month of the quarter. We have some higher frequency data for consumption, for housing. Consumption so far looks like it's holding up. Consumption growth and housing, which did decline in the last quarter, looks like it's more stable. I don't think it's going to be a big contributor to growth based on the high frequency data we have so far. But based on that data, it looks like it's stabilizing, so shouldn't subtract from growth. Yes, look, I will be the first one to admit that it's although we're actually well into the second quarter. We don't have that much data yet. There's always uncertainty. We've seen a lot of volatility in the month-to-month data, but when you look at our surveys, you look at the high-frequency data we have, we do think the Canadian economy is poised to return to growth in the second quarter.
All right, now I'm going to call on Max Sato from Mace News. Go ahead, please, Max.
Hi, good morning, all. Thank you, Paul. Governor, my question is, this is not just for Canada, but many other countries. Energy and commodity prices remain elevated, and consumers in many industrial sectors are not receiving the full benefits of higher energy prices, as you mentioned. And in Asia, shortages of naphtha and other materials are affecting the production of plastics and resins, which could lower the supply of appliances, vehicles, and medical equipment to other regions. So when this is happening, don't you think there's a need for governments to ask households and businesses to use less energy during the peak times and seasons to help central banks control inflation and mitigate its impact on economic growth?
Well, Max, that's not a decision the central bank makes. I mean, what you're describing is the risk we've been talking about in answer to other questions, which is the risk that higher commodity prices start to spread into other goods and services. If that happens, our job is to deal with the inflationary impacts. Direction on how to conserve energy is well outside our mandate.
Okay. Governor, you don't have any answer?
No, I think we'll move on. Our final question is from Rob McClister of Mortgage Logic News. Go ahead, please, Rob.
Good morning. At historical monthly rates of change, the average of median and trim inflation would take several months to get back above 3%, which is the control ceiling. Would that be your expectation, assuming oil prices stayed in the $90 plus range? And if so, would you need to see average core inflation near or above 3% to seriously think about imminent tightening?
Well, first of all, let me clarify how we think about the 1% to 3% range. First of all, the range, our target is for total CPI inflation, and the range, it is the 2% midpoint of a 1% to 3% range. You shouldn't think of the range as sort of hard, a hard boundary. You should think of the range really more as a way to try to help explain to people what is kind of the normal variation in inflation. So, I mean, if you look over history, at least pre-COVID, total CPI inflation was within the 1% to 3% range 80% of the time. Obviously, we have a 2% target. We can't literally hit 2% every month, but 80% of the time it's bouncing around in the 1% to 3% range. And I think as long as it's in that range, well, it's a pretty normal state of affairs. Occasionally, there are big shocks that can push it outside of the range. And it's on us to explain, okay, why is it outside of the range, and what are we going to do to get it back into the range? So we use core inflation really more, especially in this context, as a tool to help us understand how generalized price increases are. If the only reason inflation goes up is because of one price, higher oil prices, higher gasoline prices, or a small number of prices related to energy, that's more of a relative price shock, and it's not really inflation. So it tends to be something we would look through, where we tend to look through the first round effects, particularly when there's some weakness in the economy, which reduces the risk that it's going to get passed through to other goods and services. If we start to see core inflation drift up because it is, higher energy prices are spreading, that is certainly something that would get our attention, because that would suggest that CPI inflation is not going to come down to the target. And we might have to take some action to get it to come down to the target. So I hope that helps you think about the role of the band.
Okay, and that will conclude today's press conference. Thank you, Governor Macklem, Senior Deputy Governor Rogers. Thank you all for joining us. We'll see you again.
You've been listening to the Bank of Canada Governor Tiff Macklem and Senior Deputy Governor Carolyn Rogers talking about the reasons they held the policy steady at 2.25% for yet another round. No surprise, really, from anybody on this one. But the governor is saying economic weakness combined with rising inflation is a dilemma for monetary policy. Raising rates to dampen inflation could further slow the economy. Easing rates to support growth increases the risk that higher inflation becomes persistent. He also addressed some concerns about a recession, saying it's weak now, the economy, but he would not use the word recession. Across the industries, more than half of them saw growth. So he says we have to see what happens with it, how it unfolds. The two big risks, of course, right now, oil and trade, they are weighing on things. And with oil, he said he was not going to let the war in the Middle East become an inflation problem here. If not resolved, the consecutive increases could be on the way. There's oil right now, taking a look. It is up today, up above 90 a barrel. And one other note we want to talk about, Apotex has started trading. It's had its IPO yesterday, largest in Canada since 2021. It's officially trading today. I was supposed to come in at about $24. It's now trading up 12.25%, at $26.94 on its first day of trading. We have more coming up after the break.